Well, welcome everybody. We are here today to talk about how to purchase and finance rental properties. And I've got my good buddy, Jerrod Paterson here with me. He's our sponsor and co-host today. My name is Joe Massey with Castle & Cooke Mortgage, and I'm a senior loan officer. I've been a part of the York Castle First Alliance team for more than 13 years. Our co-presenter, unfortunately, was unable to join us today. His name is Justin Cooper. He's a senior loan officer with Pine Financial Group. We're going to have a portion of the presentation where we'll teach you how to use a hard money loan to acquire rental properties. Normally, Justin presents on that, but I'll be handling that for us today. But our co-host, Mr. Jerrod Paterson. Jerrod, who are you?
Well, hey guys, I'm Jerrod Paterson with First Alliance Title. I'm one of the relationship managers over here, and I've been in the real estate world for 30 years. Started off as an agent for 22 in Pennsylvania and sold over 800 homes in my career. And so have been on the investing side. At one point had 38 doors to my name. Still keep 18, but so know that side of the world very, very well. My job is to be a resource to you. I love sitting down and analyzing how you can grow your business. Let me show you what you need to do on a daily, weekly, and monthly basis to achieve your goals. So use me as a resource, and let's sit down and talk about it.
Absolutely. Guys, if you have not worked with Jerrod, I would highly encourage you to reach out to him. I've worked with the First Alliance team for, 5, 7, 8, 10 years, however long you guys have been around.
10.
Has it been 10 years now?
Just celebrated 10 years this year, yeah.
All right. They are a fantastic resource. So make sure you're reaching out to them on any listings or anything that comes up that you need help with for your listings, or if you're having a title issue. Jerrod and the rest of the team over there are just absolutely outstanding resources. So again, my name is Joe Massey, Castle & Cooke Mortgage, and we are talking today about how to purchase and finance rental properties. So let's dive in here. So what are the most common ways to purchase investment properties? Number one, purchase the property with cash. Pretty straightforward. We're going to talk about that. Number two, purchase the property with a new mortgage. This is the way most of us bought our home. We saved up 5, 10, 15, 20% down. We made our down payment. We got a new regular 30-year fixed rate mortgage, and we move along making the payments. That's how you can buy an investment property as well. Number three, purchase the property with a hard money loan or some sort of short-term financing, and then after you complete the renovations, refinance into permanent financing with me. Or number four, one of my favorites, purchase a multi-unit property as a primary residence, live in one unit, and rent out the other units. This is really, really popular right now. It's called house hacking, if you've heard that phrase, and it is a great way that you can purchase your first investment property or help your clients purchase their first investment property. What we're going to talk about today is how does each scenario work? What are the pros and cons of each scenario, and which one of these four is the best choice? So number one scenario is purchasing a property with cash. So let's say you have a purchase price of $210,000. Now, Jerrod, if I pay cash for a property, do I have any closing costs?
Sure.
Absolutely.
Yeah,
I still got to pay the title closing fee, the initial homeowner's insurance. I've got to pay water transfer fees or HOA dues or anything like that. So in this example, closing costs were $553. So walking out of First Alliance Title with the keys, $553 investment. Now this property needed $0 of renovation. So total investment into the deal to have this property ready to go, $210,553. Now over here is our cash flow statement. So the annual rental income is $1,800 a month times 12 months is this $21,600 per year. Now vacancy. Jerrod, how much is vacancy right now? Do you know?
It's about 3%.
That's right. It's about 3%.
Yep.
Now, I always estimate 5% for vacancy. This is the period of time over the course of the year that the property is going to be vacant. You don't have a tenant in there. And so I always like to estimate 5% because historically 5% is about average. Right now we're well below average at only 3%, but that's kind of abnormal. So I always factor in a loss of about 5%, that's the period of time that property is not going to be occupied. And then you've got other expenses such as property management. I estimated 10% of monthly rents. Reserves. This is really important. This is information, or this is funds that you want to keep in the event that you have to make repairs on the property. Homeowners Association dues. This HOA was not terribly expensive, but not terribly inexpensive, about about $375 a month. Property taxes, you do always have to pay those property taxes, and then insurance. So this property is a condo, as you can see with the HOA dues. So the insurance, you're only insuring the interior of the unit, about $499 a month. And then any other expenses, you might have utilities, you might have trash, electric, landscaping, snow removal, anything else you might run across. For this example, there was nothing else. So the total annual expenses, $10,282. So we take this expected annual rental income minus the expenses, gives us that annual net operating income of $10,238. Now, the most important bill you're always going to have is the mortgage payment. But in this case, we paid cash for the property. So your mortgage payment is zero. So your annual cash flow before taxes, $10,238, which results in a 4.9% cash on cash return, which gives you the exact same 4.9% cap rate because you paid cash for the property. So those two numbers equal each other. And your gross rent multiplier in this scenario is 116.7. That's a really good GRM. If you find properties like that, you find these in this market, buy them. And if you don't buy them, call me and I will buy them. Okay. Now, the return on investment, this is a really important piece. So the return on investment quadrant, there's 4 ways that you make money in real estate. Number 1 is cash flow, and that's what we're getting right there. Number 2 is depreciation. You get tax benefits because you can depreciate that property over time. Number 3, you get debt reduction. All right, in this case, there's no debt, so you're not paying down the debt, but in other examples, we will see debt reduction. And then number 3 is appreciation. How much is that property going up in value every single month? And in this case, we've estimated it's going to go up 5% per year. So you're going to have appreciation on 5% of that value. So this property appreciates $10,500 in that first year. So we combine all of these for your total return, $22,815. And we divide that into this total value of the property, and you get a 4.9% cash flow return, a 1% depreciation return, 0% debt reduction, of course, and 5% appreciation, gives you that 10.8% return on investment. So pretty solid investment in my mind. What do you think, Jerrod?
Oh yeah, solid.
Yeah,
all day, every day.
Yeah, I would do these all day, every day. You're exactly right. Now, I also have a chart here that we can see, when do we achieve positive cash flow? Well, that's going to happen right here in year number 1 because we have no debt. We're only receiving income and we're only paying out our expenses. So that property achieves positive cash flow right out of the gates in year number 1. And then over the course of 30 years, how much return do you get on this? More than $85,000 in that last year is how much that would return over the course of 30 years. So we've got an investment property spreadsheet that'll be posted on the recording that you can look at the link down below. And we've got a training for that. And you can plug in your individual scenarios and see how this would work for one of your properties. But that's the way we analyze these. And really important to see this positive cash flow being achieved right there in year number 1. So big benefits of paying cash. Number 1, you're getting a really great cap rate, really great return on investment. You don't have to qualify for a loan. You don't have to mess with any pesky lenders asking for your bank statements, your tax returns, your W-2s. We need this letter. We need your credit report. We don't have to do any of that. And then that qualifies you for no monthly payments. But you might need a large amount of money and you may only be able to buy just a few properties, right? Let's say I've got $250,000 to invest in real estate. I could only buy one of these, okay? Now, what is the number 1 piece of feedback that I get on this slide? Anybody want to guess?
I don't have 200 grand.
That's the number 2 piece of feedback.
All right.
The number one piece of feedback is, yeah, Joe, this is great, but these properties don't exist anymore. There's no good deals in Denver. All right. Well, that's true with one exception. This is a real transaction. Everything I'm going to show you today is a real transaction and a real investment property that one of my clients closed within the last 12 months. This property was on the MLS. This is about 3 months ago when there was 1.6 months of inventory. Okay, so everything I'm going to show you today is a real transaction.
Solid. All day, every day.
All right. Scenario number 2. Let's put a 15% down payment to purchase a new investment property. Now, a question I would ask you is, what is the minimum down payment to purchase an investment property? Most common answer I get is 20%. Second most common answer I get is 25%. The real answer, 15%. 15% is the minimum down payment to purchase an investment property. So this was a property that had a price of $263,000. We loaned them 85%, $223,000. They brought to the closing $39,450. Now, when you're putting less money down, you're going to have higher closing costs, roughly $6,500. Walking out of First Alliance Title with the keys, they spent $45,950. Renovation, $6,000, pretty minor. I think they had to spruce up a couple of bathrooms, not much. Total investment to have this property rent ready, $51,950. So let's look at our cash flow statement. This property rents for a little bit more, $22.50 per month. We've got vacancy factored in. We've got our property management. We've got repairs. We've got HOA dues, property taxes, and insurance. So net operating income, $16,324. But now we have to pay our biggest expense, which is the mortgage, and in this case, mortgage insurance, all right, because they didn't put 20% down. So the annual cash flow, negative $4,088. So Jerrod, good deal or bad deal so far?
I'm going to tell you, you know this, and it's not always all about cash flow.
That's exactly right. It is not always all about cash flow. So we have a negative 7.8% cash on cash return, yet this property is a 6.1% cap rate and a 119% GRM. That's pretty solid, guys. That is pretty solid. Now, you might be saying, how is it solid if we're losing that much money every single year? Well, let's dive in and look. Cash flow, negative $4,000. Tax benefits from depreciation, $2,600. Debt reduction, because who is paying down the debt for us? The tenant. We're not paying it down ourselves. Appreciation. This property appreciates at 5%. We're going to add all 4 of those quadrants together. Our return is $13,758. Now, how much did we invest? $51,950. So when we divide these returns into the cash we invested, yes, we have negative cash flow, but we're getting a 5% return from depreciation. We're getting a 3% return from debt reduction, and we're getting a 25% return from appreciation. When we accumulate all of these together, this is a 25.9% return. Jerrod, let me ask you, do you get 25.9% in your IRA or your 401k?
I wish.
Me neither.
Yeah.
Me neither. All right. So what you need to understand is, yes, the cash flow is low, but you are achieving positive cash flow after 7 years, but you're achieving a positive return right out of the gates. All right. So right out of the gates, you're getting a positive return. You're going to have to be subsidizing the property by applying additional money towards that monthly payment until you reach year number 7. But then after that, you're going to have positive cash flow all the way until that loan is paid off. And then you're going to have really positive cash flow. So in the last year, if you own this property 30 years, this property would generate you $115,000 in that year. It would generate 3 times your initial investment in the very last year that you were to own this property. So the big point to understand here is, Yes, this is negative cash flow, but you're investing a lot less money into the property, which allows you to get a much bigger return, particularly over the long term. So big benefits, you're getting a 6.1% cap rate, 25% return on investment, much less cash into the deal. If I had my same $250,000 that I mentioned in the last slide, I could buy 4, maybe even 5 of these, right? Which allows me to spread out and purchase more properties. Now the downsides, it does have negative cash flow. I would describe that as deferred down payment, meaning I'm subsidizing this property to the tune of $4,000 a year for the next 7 years. That's an additional $28,000. But how much would I have had to put additional down payment in order to get positive cash flow? Significantly more than that. So you just need to understand this negative cash flow is just simply deferred down payment. And you do have to qualify for a new loan, right? Of course, that's always important. If you are taking out a new mortgage, you do have to qualify for it. And then vacancies will have more of an impact because if the tenant moves out, you've got to pay that payment on a monthly basis. And the last one, depending on the condition of the property, it may not qualify for financing. Now, this one needed really low renovation, only $6,000. But sometimes you'll see properties that need a lot of renovation and they're not habitable. I don't like that word, habitable. I can barely spit it out. But if you find a property that doesn't need a lot of renovation, this can be a great way to purchase with very, very little money down. So this property, again, is a real transaction. It was on the MLS about 6 months ago when there was 1.3 months of inventory. So let's talk about scenario 2B. Let's purchase with 25% down and let's see what happens here. Now this property is a single family residence with a basement apartment. Purchase price of $475,000. We loaned them 75%. They put 25% down. Closing costs roughly $5,600. Walking out of First Alliance Title with the keys, we've got $124,000 invested. Total renovation, $25,000. That was really all invested into the basement apartment. They had to put in a kitchenette. They had to fix up this separate entrance. They had to put in some egress windows, new paint, lighting, carpet. They had to spruce up the bathroom. So they put a lot of money into that basement apartment. So total investment into the deal, $149,350. But how does this work out on a cash flow standpoint? Really solid. They rent the upstairs, which is a 3-bedroom home, for $2,200 a month. The basement apartment, they rent for $1,000 a month. So a total of $3,200 a month. Minus 5% vacancy gives us our expected annual rents, minus property management, minus reserves for repairs, minus property taxes, minus insurance, gives us total annual expenses of $8,900, $27,000 net operating income. What's the biggest bill we always have to pay? That mortgage, $29,000 a year. So we have negative cash flow, $1,625 per year. But let's look at this. Negative cash flow, but it's a 5.5% cap rate and a 156 GRM. So Jerrod, before we look at the return on investment, good deal or bad deal?
Average deal.
Average deal. I completely agree. Average deal. So let's see, how does an average deal look if we were to buy it? Well, we've got negative cash flow. We're getting depreciation. We're getting debt reduction. We're getting appreciation for a total return of $30,271. We're going to divide that into our total investment of $149,000. So we have negative 1.1% cash flow, positive 3.1% depreciation, positive 2.3% debt reduction, positive 15% appreciation, 20.3% annual return. So average deal, I completely agree. Jerrod, are you getting 20% in your IRA, your 401k, or your savings account at Capital One?
Nope.
Me neither. All right. So it's an important point. An average deal is still returning 20% per year. Okay. You're going to achieve positive cash flow in year number 3. So you're going to be subsidizing this property to the tune of $1,600 a year for the first 3 years. But then after that, you're going to achieve positive cash flow, and this property is going to begin making money for all of the following years. And in that 30th year of owning it, this property will return you $196,000 per year. Okay. So the important point to understand is, yes, negative cash flow can be scary, but what does that do for you over the coming 30 years? And the answer to that is generates a lot of wealth. Okay. So big benefits here: 5.5% cap rate, 20% return on investment. You are much closer to your break-even cash flow. Remember, in the last scenario, break-even was all the way over here at 7 years. In this case, we've put more money down and we've shortened that break-even cash flow point by 4 years. However, you definitely have to qualify for a new loan, and depending on the condition of the property, it may not qualify for financing. But let's assume that this one did, because all they were doing was putting in $25,000 into the basement apartment. So this is another real deal that was purchased about 8 months ago. Again, on the MLS, 1.1 months of inventory. So these are real deals that are out there. I've actually seen very similar deals in the last 30 days that my clients have been buying. So if you have clients that are thinking about buying investment properties, these are absolutely out there. They're absolutely available. And we're seeing a pickup in inventory. There's going to start being some sellers that are willing to bargain with you, maybe lower their price, maybe pay some seller concessions. You're going to start seeing a lot more of these really great opportunities like this one. So let's talk about the process of purchasing with a hard money loan. So the number one thing you're going to do is locate the property. And you want something that's in a good rental market, not something that's in a good resale market. Okay, so it's really important that it's in a good rental market. And then you're going to get it under contract and prepare your repair budget. You're going to go through your analysis, and it's very important to make sure that you've got sufficient equity in that property. Then you're going to get your hard money loan, and they're going to loan you up to 70% of the after repaired value. So up to 70% of the value after you've made your repairs. Then you're going to close on it. You're going to fix up the property. Then you're going to put a tenant in place. And then you're going to give me a phone call and say, you know what, Joe, I want to refinance my hard money loan. I will say, fantastic. We will loan you up to 75% of the new appraised value. Great. Then you're going to hire a management company or manage the property yourself. And if you're really happy with that, you're going to go back up here and do that all over again. Now let's see, we had a question, how much is sufficient equity? So right here, at least 30% equity based on the ARV. So your after repaired value is how much that property is going to be worth after you fix it up. And so you need to make sure you've got at least 30% equity in order to purchase this property based on this 70% ARV from your hard money lender. Okay, really good question. I'm glad you asked that. So let's look at a sample scenario. We're going to purchase with a short-term loan, a hard money loan, and then we're going to refinance that with permanent conventional financing. Now this property was a duplex with an 885 ARV. Now they bought this property for $370,000. So Jerrod, let me ask you, if this property has an 885 ARV and I'm buying it for $370,000, what does that tell you about the property?
Tells me you need some work and you're going to put about 170 to 175 grand into it.
You are very good. This property needed $175,000 because it was busted. All right. It was in really, really bad shape. They had to do a lot of work to this property. And so Jerrod's exactly right. When you find a property like this that has sufficient equity, you know you're going to have to be putting some work into it to bump up that after repaired value. Now, closing costs were roughly $27,000. Why in the world would the closing costs be so high, Jerrod?
Hard money.
That's exactly right. So a hard money loan is high leverage, high interest, and short term, but they allow you to borrow even more than what you're paying for the property. So the hard money loan was $572,000. So walking out of First Alliance Title, guess how much money they needed? $0. Okay, $0 and 0 cents. So the purchase price was $370 plus that renovation of $175 plus the closing costs equals 100% financing from that hard money lender. Now they bought the property, walking out of Jerrod's office with the keys, they immediately started renovating the property. It took them 8 months to renovate the property, and they had to make a hard money loan payment every month of $6,670. So over 8 months, they spent $53,000 in total holding costs. Then they called me up and said, Joe, we're ready to refinance this property. We want to pay off our hard money loan. I said, fantastic. We're going to pay off the hard money loan. New closing costs for our new loan are going to be financed into the loan. So their new loan amount was $580,000. Guess how much money they needed for the refinance? $0. What was their total investment? 0 plus 53,000 plus 0. $53,360 was their total investment to purchase an $885,000 property. So let's do some math real quick. Let me bring the calculator on screen here. 53,360 divided by 885,000. That is a 6% down payment. So Jerrod, let me ask you, is there a lot of ways that you can buy an investment property with only 6% down?
No, not at all. I mean,
yeah. This is a really, really great example of a no money down program. All right. So this is an excellent example, an excellent investor. And again, this is a real transaction. I'll show you how they bought this property in a moment. Let's look at our cash flow statement. Each side is rented out for $2,900 a month, minus vacancy. This property top line revenue is $66,000 a year, minus management, minus reserves, minus taxes, minus insurance, net operating income, $46,000 a year. But what's the biggest expense? They got to pay the mortgage, $47,000. So they are losing $800 a year on this property. So Jerrod, good deal or bad deal so far?
That's good.
This is an exceptionally good deal.
Good. Yeah, exactly.
Exceptionally good deal. And let's show you why. Negative 1.5% cash flow, 8% cap rate, 99 gross rent multiplier. All right. Let's look at our overall return on investment and see what that says. Negative $800 in cash flow.
Hello.
$8,700 in depreciation, $5,600 in debt reduction, $44,000 of appreciation. That's a total return of $57,000. How much did we invest? $53,000. So let's not forget, we've got negative 1% cash flow, 16% depreciation return, 10% debt reduction return, 82% appreciation return. Now, Jerrod, I know your 401k must get at least 108%, right?
Yeah, after 10 years.
Right? Exactly. So this is how you can purchase property with very, very little money down and get an exceptionally high return. And let's not forget, how much equity do they have in this property? So this loan amount is $580, $885 value, $580 loan, $305,000 of equity that they built by doing the work on this property. So let's do a little bit more math here. So we've got $305,000 of equity plus $57,818 of return in the first year, divided by our investment of $53,360. That is a 6 times return on their money. That is a 679% return on their money in the first year. Is that a good deal, Jerrod? What do you think?
Yeah.
Yeah.
You'd say
Me too.
so.
Me too. Now, what did they have to do?
Deal of the day we see,
Yeah.
obviously.
They had to find the property. They had to get it under contract. They had to renovate it, which is hard work, right?
Absolutely.
Then they had to put in a tenant, And all of that, they had to qualify for the loan. But all of those pieces falling into place allows them to get a 679% return in the first year. That's pretty darn good, I think. That is pretty darn good. So how does that look over the long term? Let's clean this up a little bit here. Positive cash flow achieved right here in year number 2 over the course of 30 years. At the end of 30 years, if they still own this property, it will be generating them $352,000 per year. I think that's a pretty darn good return, especially considering they got $300,000 of equity on day number 1 after completing the renovation. So who would like this deal? Is this a good deal? Type yes in the chat if you think this is a good deal.
Hey, you find that deal at any agents, I'll buy that tomorrow.
Yeah, I think this is an exceptionally good deal. And this was purchased from a wholesaler. How many wholesale emails do you get a day, Jerrod?
About a dozen.
Me too. All right. So I get about a dozen of these that come across my desk every single day. And this was in a very hot seller's market with less than 1 month of inventory. And we completed this refinance about 2 months ago. So remember I mentioned we're going to show you all real transactions. This is another real transaction that one of my clients closed on, and we closed on this refinance about 2 months ago. So these are all real transactions available, and you get, I don't know, 12 wholesale emails a day. These deals are absolutely out there and available for you to pick up. Let's talk about the benefits and risks. So number 1, you're getting a great return on investment, very little cash into the deal. You have the ability to purchase more and more properties, and you're getting really good cash flow with very little investment. However, it is more difficult to qualify for the loan because you're qualifying for 2 loans. You have less equity in the property at the beginning and more leverage on the investor. But once you complete the renovation, that flips and you have a ton of equity. Vacancies have a really high impact, particularly while you're doing the renovation. And this is the most important point, guys. You may not have to put cash into the deal, but you still need to have some good cash in order to qualify. And the final key point is the appraisal is the key determining factor on the approval of the loan. You need to be prepared to bring some money to the closing, and you should expect to put between 3 and 15% into the transaction. And this example that we've looked at is a best case scenario, and it is a real scenario. I have all the closing statements. I did the loan, but your real world results might be different. And there are a number of factors that can affect your results. So you really need to be prepared to put cash into the transaction, depending on the appraisal and depending on your approval terms. Okay. So I hope this makes sense. Let's see. Delilah asked, in this scenario, have you ever had a client who could not refinance? What are the reasons that might occur? Yes, I have. Now, here's the number one thing you want to do when you're going back and you're doing your due diligence and your analysis on the property. You want to get pre-approved with me to make sure that you can qualify for that new loan. Now, I've had clients get under contract to buy a property with hard money, and then they'll call me and say, hey, Joe, I want to be pre-approved for my takeout financing. And we'll look at it, and they have bad credit, no income, no job, tax liens, things like that. And I'll tell them right up front on day 1, hey, this is not going to work for you because you don't have enough credit to qualify, or you don't have enough income to qualify. And we let them know that ahead of time. Now, the other scenario, sometimes we'll see that clients will buy a property with a hard money loan, wanting to keep it as a rental, and they will not get pre-approved. And then they'll put in a tenant and they'll call me and they'll say, hey, Joe, I saw your webinar 6 months ago and now I'm ready to refinance. And we'll go through and run into some issues. They have bad credit, they have tax liens, they have judgments, the property doesn't appraise, all sorts of different reasons that their loan could be turned down. You don't want to be that second scenario. You want to make sure you get pre-approved first before you go out and buy the property and before you go out and take out that hard money loan. So such a great question. I'm really happy that you asked that because you want to make sure back here that you can be pre-approved for the hard money loan as well as pre-approved for the permanent financing with me. So it's very important that you take both of those steps. I'm really glad you asked that. Any other questions on this one? This is a more complex transaction. I completely get that, and happy to answer any other questions or thoughts that you guys have on this one. Scenario number 4. Let's purchase a multi-unit as your primary residence. And again, we've got a single family home with a basement apartment. So $475,000 purchase price, 5% down. Now, Jerrod, how can I buy an investment property with only 5% down? I said earlier the minimum down payment was 15%. How were they able to do only 5%?
Owner occupied.
That's right. This is a primary residence. Down payment, $23,750. Closing costs, roughly $7,500. Walking out of First Alliance title with the keys, $31,250. And it needed $6,000 in renovation to spruce up the basement apartment. Total investment, $37,250. Now this is really going to blow you guys away. $3,400 a month in rent. So there's an upstairs that rents for $2,400 a month. I believe it's a 4-bedroom home, rents for $2,400 a month. In the basement, there are 3 bedrooms. All right. So the owner lives in one of the bedrooms, and he rents out bedroom number 2 and bedroom number 3 for $500 a month. Now it's tight living quarters. Let's be clear about that. All right. But he is living in that one basement bedroom, and the tenants are paying for bedroom number 2 and bedroom number 3. Or I guess they're tenants, but they're really roommates. And then he's got tenants upstairs that are paying $2,400 a month for the entire upstairs unit. So net income, $40,000 minus vacancy, minus reserves, minus property taxes, minus property insurance. Now there's no property management because he lives there. He manages the property himself. $31,000 net operating income. Got to make the mortgage payment. Got to pay the mortgage insurance. Annual cash flow, negative $6,097. So he's losing $500 a month. Jerrod, good deal or bad deal?
To be determined. I think still good because, when you, again, I'm a big opponent of cash flow is not everything.
I think you're exactly right.
Good. Yeah.
So we got to factor in one more important point. He would have to live somewhere if he wasn't living in that basement apartment. So this is a really smart investor. And he says, hey, if I wanted to buy a $475,000 home, I would have to spend $3,700 on a mortgage. Now I'm only spending $500 on a mortgage. So what he does is he still takes this $37,000 a year that he would have to spend, and he pays the first $6,000 to his mortgage because he's got to keep up the mortgage payments. But he takes the remaining amount and applies that back into his savings because he knows that he is living well below his means. He doesn't take that savings and go to Las Vegas. He doesn't take that savings and go out and drink every night. He takes that savings and applies it back into his savings account. So what does that do for him? This is an 84% cash on cash return. So think about that. He's making $31,000 a year on a $37,000 investment. This is a 6.5% cap rate, 141 gross rent multiplier. How does this work for our return on investment? Let's take a look. $31,000 in cash flow, $0 in depreciation because it's his primary residence. He can't depreciate it. The tenants are paying down the debt, $4,600. The property's appreciating $23,000. That's a $59,000 return. That's 84% from cash flow, 0% from depreciation, 12% from debt reduction, 63% from appreciation. That's a 160% return in the first year. So think about that for a moment. He invested $37,000 in the first year. That investment has returned him $59,000. So Jerrod, you're a stock guy, you're a financial planner. If you were to give him $37,000, would he give you after a year $37,000 plus another $59,000?
If I got 3,700, I would be happy.
Exactly. Exactly. All right. Now, there's pros and cons to this, right? You're getting positive cash flow right here in year one. That's great. You're going to have a $300,000 return later in life after he's owned this property for 30 years. But with this huge return on investment, with this super low down payment, with this excellent cash flow, you have to live with your tenant. In this case, he has to live with 2 roommates plus tenants upstairs. Not great living situation, right? This would not be for me. Maybe you're married or your client is married and has a dog and children. This is not for everybody. This is for folks that are looking to maximize the return on their investment. And you need to be disciplined. And you need to live there for a minimum of 12 months. Okay. So there are pros and cons to this. While this number is cool, holy cow, I love 160%. Hey, we'd be happy to get you 160%. You just have to move into a cold, dark basement with your tenants and your tenants upstairs. Maybe that's not for me, or maybe it is. All right. So while the math is excellent, the client needs to understand the pros and cons to it. And this was about 6 months ago. This was on the MLS, 1.3 months of inventory. And I have dozens, probably hundreds of these examples for clients that we've closed on these types of transactions with recently.
And guys, I did this. I started out, I moved every year for 10 years straight. And I literally, that's how I started my investment portfolio. Is I bought every one of those properties owner occupied financing on top of buying some additional properties during it. But every one of those that I bought was all owner occupied. So house hacking, roommates, et cetera.
Yep.
Can be done.
It absolutely can. So now, which option is the right one? So if we pay cash, we've got a pretty big investment. We've got great cash flow, and we've got a 10% return on investment. How long does it take to achieve cash flow? Immediately, right? Or what if I want to put 15% down? I've got a lower amount down, negative cash flow. I'm still getting 25% return, but it takes 7 years for me to get positive cash flow. Or if I put 25% down, I have a lot less negative cash flow. I'm getting a 20% return, and I'll have positive cash flow after 3 years. Or I can do that hard money loan, comes with some work, right? Very light negative cash flow, incredibly strong return on investment, and I'll have positive cash flow in year number 2. Or I can purchase that primary residence with 5% down, super great cash flow right out of the gate, 160% return, and immediate cash flow. So Jerrod, let me ask you, which one is the right one? Which one should we advise someone to do?
The one that's best for them.
That's exactly right. Only the investor can answer the question of which scenario is right. So Jerrod hit the nail on the head. The investor is the one that will determine which scenario is right for them. And what we want to do is make sure they understand that the best option is completely up to them, and they should carefully review all of the following areas to make the right decision: their personal financial situation, their risk tolerance, can they qualify for a loan, what are their assets, what are their investment goals, any tax implications, right? There's a lot that goes into this, but any one of these strategies can make money. In fact, I've had one client that has done all 5 of these strategies. So not every strategy is the only one that the client is going to use. Client might use strategy number 1, number 3, then number 4, then number 5, then number 2. Who knows, right? They're going to go in whatever order they want to use in order to achieve their investment goals, okay? How can Pine Financial help you? Well, Justin Cooper at Pine, they can help you with that short-term hard money loan up to 70% of the after repaired value. They will finance up to 100% of your renovation costs. The term of their loans are 9 months with, this is pretty cool, no mortgage insurance, no prepayment penalty, no down payment. All right. This is a great tool that you can use to acquire properties. Or if you say, hey, I want a lower cost option, I'm willing to put a little bit of money down, you can close as fast as 72 hours with 10% down and no renovation funds. So super fast, super good transactions. I do a lot of work with the folks over at Pine, and they are absolutely outstanding to work with. And if you have questions about that, reach out to Justin Cooper from Pine Financial, Justin at pinefinancialgroup.com, 303-885-4445. And my name again is Joe Massey with Castle and Cooke Mortgage, and we do every single type of loan that we've spoken about today. So most important that we've covered today: investment properties, investor cash flow loans, FHA, purchases, refinances. We also offer home equity lines of credit and fixed rate second mortgages on your primary residence, as well as investment properties. And you can go to this QR code right there, click on that with your phone, and you can download our investment property spreadsheet. And our esteemed colleague, Mr. Jerrod Paterson, tell us why we should talk to you and the folks over at First Alliance Title.
Yeah, guys, it's, like I said, I've been in this industry for over 30 years, started out as an agent. And so sitting down and helping you grow your business, I can give you, real world advice on achieving those goals. So I help you get some databases together, help you through accountability calls. If you want to achieve big things, you can use the QR codes there, download my card. We also have our app, which are great for closing cost estimation. There's even great flyers and social media posts on there. So let me help you.
Absolutely. All right, guys, thanks so much for joining us today. If other things come up, call, text, email, reach out to Jerrod, reach out to myself, reach out to Justin. We would always be happy to chat, and we'll look forward to seeing you guys in a few weeks at our next class. Thanks, guys.
Thanks, everybody.